Advanced Drainage Systems, ticker WMS, just beat Q1 fiscal 2027 consensus, and we are starting straight with the numbers.
Let's get right into it.
So revenue topped $1 billion for the first time in company history, coming in at $1.001 billion.
Which is huge.
Right, it is. That is up 21% year over year. And adjusted EPS landed at $2.49, just absolutely crushing the $2.10 estimate.
A massive beat on the bottom line.
Yeah, exactly. And management maintained their full-year guidance, so that is $3.35 billion to $3.55 billion. But here's the catch. Immediately following this print, shares traded down roughly 3% to the mid-140s.
Right, which is exactly why our mission for this deep dive is to unpack this paradox for you, the retail investor.
Because it is a paradox, right?
Oh, totally. I mean, you are looking at a historic $1 billion top line and a massive bottom line beat, yet it triggered a stock sell-off.
Right.
So the answer to why Wall Street hit the sell button, it doesn't live in those headline numbers.
No, it rarely does.
Exactly. It lies buried in the margin outlook, an impending cost squeeze, and a very critical detail about exactly when customers decided to time their purchases.
Well, let's get right into segment performance because, crossing that $1 billion revenue threshold is a huge milestone for a pure-play water infrastructure company.
It really is.
Yeah, so breaking down the core drivers of that top line, stormwater sales surged 24.2%.
Oh.
Yeah, up to $809.4 million. And then wastewater grew 7.5% to $191.7 million. But we have to factor in a massive contributor here, right?
The acquisition.
Exactly, the recent NDS acquisition. That deal added $94.7 million strictly to the stormwater segment.
Which is a big chunk of change.
It is. And according to the filings, this marked NDS's strongest quarter historically.
Yeah, and NDS is just a critical piece of the puzzle here. I mean, advanced drainage has historically dominated large-scale municipal and commercial pipe system.
The big stuff.
Right, the massive projects. But NDS brings this really strong portfolio in residential and light commercial water management.
Okay, so it kind of rounds out their offerings.
Exactly. Integrating them rounds out the whole product catalog.
Yeah.
But to your point, we have to isolate that acquisition to see what the core business is actually doing.
Right, because you can't just buy growth forever and call it organic.
Bingo. So if you strip out that $94.7 million from NDS, the organic growth for the stormwater segment was actually 9.7%.
Which still sounds pretty good, but this is exactly where we have to challenge that 9.7% organic growth figure.
Yeah, there is a catch.
A big one. Management revealed a crucial caveat on the earnings call. They said approximately $25 million to $30 million of that revenue was actually pulled forward from Q2 into Q1.
Right.
I mean, if customers are just front-running announced price increases, isn't that just borrowing from tomorrow's paycheck?
It absolutely is.
So for anyone listening who is trying to model out Q2, this makes that 9% organic growth look like, well, a bit of a mirage, doesn't it?
It really does. It fundamentally changes the math for the back half of the year.
Yeah.
Well, the mechanism here is pretty straightforward. It's like a supermarket announcing that the price of milk is going to double next week.
Oh, right. So everyone panics.
Exactly. Naturally, everyone rushes in and buys 3 gallons today. So it makes today's sales look incredible, right?
But the store is going to be empty next week.
Exactly. A total ghost town.
Yeah.
Customers knew advanced drainage was hiking prices, so they just accelerated their orders to lock in the old rates.
That makes sense.
Yeah. So if you adjust for that $25 to $30 million timing shift, that organic growth drops from nearly 10% all the way down to the mid-single digits.
Wow. Okay. Which means Q2 is going to face a very tough sequential comparison.
Definitely.
But, selling a ton of pipe early, it doesn't mean much if it compresses your profitability down the line. And I think this brings us to the most glaring contradiction in the report.
The margins.
Yes, the margins. In Q1, their adjusted EBITDA margin expanded a massive 230 basis points to 35.8%.
Which is phenomenal.
Right, generating $358.3 million. Yet, management's maintained full-year guidance implies that margins will actually compress by 170 to 200 basis points.
Down to what, the 29% range?
Yeah, exactly, down to the 29.6 to 29.9% range. So how does the company start the year at nearly 36% margins and then guide the full year down below 30%?
Well, you have to look at the cost of the physical raw materials.
All right.
Advanced drainage relies heavily on resin to manufacture their pipes.
Just massive amounts of plastic.
Right. And they also rely heavily on diesel and third-party freight to transport these massive products to the construction sites.
Because you can't exactly ship a 20-foot pipe via FedEx.
Exactly. It takes specialized logistics.
Hmm?
And management explicitly warned that the costs for both resin and transportation are expected to hit their absolute peak in Q2 and Q3.
But wait, didn't management insist that their pricing actions will cover this inflation dollar for dollar?
They did, yeah, but only for the full year.
Oh,
Right. What we are looking at is a severe timing mismatch. In B2B manufacturing, the realization of price hikes always lags.
so they announced the increases, and
Right.
that caused that rush of early buying at the lower margins that we just talked about.
Exactly. They get flooded with low-margin orders today. Meanwhile, the actual cost of the resin and the freight to make and move those products, well, that's spiking right now.
So it's a double whammy.
Yeah. The full benefit of the higher prices won't catch up to the income statement to offset those costs until, like, the back half of the year.
So costs are peaking today, but the pricing relief doesn't arrive until tomorrow.
You nailed it.
Okay, I want to look closely at a specific accounting detail in the report, though, because I think it might be distorting the gross margin picture a little bit.
Sure, let's hear it.
There is a $14.2 million inventory step-up related to the NDS acquisition.
Right, standard M&A accounting.
Exactly. When a company executes a deal like that, they have to revalue the acquired company's stored products at fair market value.
Which hits the gross margin on paper.
Right, on paper, but it doesn't mean cash is literally walking out the door. So my question is Wall Street just overreacting to temporary accounting noise and this one-quarter timing mismatch?
Or is it something worse?
Yeah, like, is this margin squeeze a legitimate structural threat to the company's long-term 30+% EBITDA margin targets?
So, to be blunt, Wall Street isn't overreacting to the accounting noise.
You don't think so?
No, the market knows how to strip out a non-cash inventory step-up when evaluating the core cash flow. They see right through that.
Okay, so what are they reacting to?
What investors are reacting to is the severity of this upcoming profitability trough. I mean, management warned that the margin drop in Q2 will likely be worse than the typical seasonal drop the business usually experiences.
Oh, wow. So it's going to be a sharp drop.
Right. Now, it is not a structural collapse of their long-term margin goals, but it is a very real near-term cost lag. And that forces analysts to revise their immediate earnings models downward.
Which explains the stock selling off.
Ex-
Well, if volatile resin costs are the main cyclical enemy here, let's look at how management is actually trying to control what is within their power.
The recycling plant.
Right. The company officially launched operations at their Cordell, Georgia recycling facility this quarter.
And this is a massive strategic mitigation effort on their part.
How so? Like, how does it actually move the needle on margins?
Well, by launching the Cordell facility, advanced drainage is replacing virgin resin with internally processed recycled content.
Okay, so they're making their own raw materials, essentially.
Exactly. And virgin resin prices are highly volatile because they are tied directly to the global petroleum markets.
Right. If oil spikes, resin spikes.
Exactly. So by recycling plastic in-house, they are fundamentally decoupling a large portion of their input costs from, global oil shocks.
Which is incredibly smart for long-term stability.
It is. It structurally lowers their baseline costs
Yeah.
and gives them tight control over their supply chain.
But there is a massive timeline catch with Cordell, right? Management indicated the facility will not hit full capacity until fiscal 2028.
Yeah, that is the unfortunate reality of heavy industry. It takes time to scale up the sorting, the processing, and the output of a facility that large.
So they can't just flip a switch and have cheap resin tomorrow.
Exactly. So while the long-term structural fix is in motion, it is not going to ride to the rescue and save them from the resin cost spikes hitting in Q2 and Q3 of this current year.
Yeah, they're still going to have to eat those costs for now.
Unfortunately, yes.
And speaking of long-term fixes, we have to look at the ongoing integration of NDS.
There's an acquisition.
Yeah. Despite the upfront integration costs and that $14.2 million accounting hit we just discussed, the actual cross-selling opportunities between advanced drainage and NDS are still in their very early innings.
Oh, absolutely. The cross-selling mechanics take time to materialize.
Why is that? I mean, why can't they just start selling both catalogs tomorrow?
Because the true margin expansion from the NDS deal will only come when the sales forces are fully integrated and they can pitch a unified water management platform to contractors.
Like a one-stop shop for everything water-related.
Right, but, site plans and contractor bids, They operate on very long cycles.
Yeah.
You don't just change a major supplier mid-project.
Ah, right. That makes sense. The blueprints are already drawn up.
Exactly. So it is highly promising that NDS just posted its strongest historical quarter, but fully capitalizing on those cross-selling synergies, that's a multi-year process.
Okay, so we've covered the internal cost controls and the M&A strategy, but honestly, having cheap recycled resin doesn't matter if no one is actually buying the pipes.
Brings us to demand.
Right, which brings us to the actual end customers in housing and agriculture. Now, reading through the Q1 end market data, the numbers look like an absolute boom.
On the surface, yeah.
Yeah, I mean, residential construction demand was up 29%, non-residential was up 16%, agriculture was up 22%.
Incredible growth.
Right, but then you look at the gloomy FY27 guidance. Agriculture is expected to be down double digits for the year, and residential is expected to be down mid to high single digits.
It's a huge whiplash.
It really is.
Yeah.
How do we reconcile a 29% jump in Q1 residential with a forecast for it to end the year down?
We have to look at the macroeconomic forces that are essentially choking the funding pipeline right now.
You mean interest rates?
Exactly. In the residential market, high interest rates are acting as a very heavy anchor on future housing starts.
So why was Q1 so high then?
Because that Q1 surge likely captured the tail end of housing developments that were already funded and permitted like months or even years ago.
Before rates really started biting.
Right. But looking ahead, financing a new subdivision is significantly more expensive today. So the pipeline of new projects that will require drainage infrastructure is actively constricting as we speak.
Okay, that makes sense for housing. But what about agriculture? I mean, that was up 22% in Q1, but they're guiding it down double digits for the year. That's a massive swing.
Yeah, it comes down to the mechanics of agricultural capital expenditures.
How so?
Well, farmers are currently facing sharply rising input costs, things like fertilizer, fuel, and equipment.
Right.
And at the same time, crop prices are softening.
So they're getting squeezed on both ends.
Exactly. And field drainage is a massive upfront capital expense. When a farmer's profit margin gets squeezed, digging up an entire field to lay new pipes is usually the first major project that gets delayed.
Because they can just make do with what they have for another year.
Right. Management is projecting a severe drop-off because farm budgets are simply stretched too thin to take on heavy infrastructure upgrades right now.
So the macro demand environment is clearly cooling off, and we have this temporary margin squeeze coming in Q2 and Q3.
It's a tricky setup.
It is. But if you are a retail investor holding the stock, I think the silver lining here is a truly fortress balance sheet.
Oh, without a doubt. The balance sheet is rock solid.
Yeah, the company generated $203 million in free cash flow just in the quarter. They executed $228.5 million in share repurchases.
That is aggressive buying.
Very aggressive. They also raised the quarterly dividend by 11% to 20 cents per share. And they managed to do all of this while keeping their net leverage exceptionally low at 1.5x.
You know, when a company hits a profitability trough like the one they're facing, the balance sheet basically dictates whether they play defense or offense.
And it sounds like they are playing offense.
Oh, advanced drainage is totally weaponizing their balance sheet here. Right. Having net leverage at just 1.5x gives them massive optionality.
Right.
They're actively using this period of market weakness to aggressively buy back their own stock. I mean, returning that much capital to shareholders through buybacks and an 11% dividend hike, that is management signaling extreme confidence.
Putting their money where their mouth is.
Exactly. It tells the market that they view this margin squeeze as a temporary speed bump, not a permanent impairment of their actual business model.
Okay, so let's bring this all together for the final synthesis here. Advanced Drainage Systems is a pure-play water infrastructure company navigating a tricky cost lag, which is being driven by peaking resin prices and shifting end-market demand in both housing and agriculture.
Right.
However, they are using a pristine balance sheet to aggressively buy back stock and integrate a major acquisition in NDS, all while structurally lowering their long-term costs by building out recycling capacity that will hit full stride in 2028.
Beautifully summarized.
Yeah.
And, that setup leaves us with a broader, more provocative thought to mull over.
Oh, I like those. Lay it on us.
So the market right now is hyper-focused on the immediate noise, right?
Yeah, the peak resin costs, the Q2 margin compression.
Exactly, and the timing of those customer orders. But once that short-term turbulence fades, how will the market ultimately price the climate-resilient infrastructure premium of the stock?
Oh, that's an interesting angle.
Right, because we are looking at undeniable secular trends here. Severe storm events are increasing in frequency, and the U.S. water grid is rapidly aging.
Right, it's falling apart in a lot of places.
Exactly. Advanced drainage isn't just selling plastic pipes. They're essentially selling climate adaptation.
Wow. Yeah.
So when the cyclical headwinds of, resin costs and high interest rates inevitably recede, the underlying structural necessity of managing stormwater isn't going anywhere.
It's only going to become more critical.
Exactly.
Well, to make sure you keep getting this level of clarity on the market's most confusing reports, be sure to follow the show for our daily no-fluff earnings coverage. We will be right here to help you read the next one.